You're watching a special broadcast of the South African Monetary Policy Committee, which has taken a decision, I think, that's set to shape South Africa's inflation future in a not totally different direction, but certainly lower than it's been for the past 30 years of democracy. Discussing these issues with me today after that decision to cut interest rates by the bank is Annabel Bishop, Chief Economist, Investec. She's with me here in studio. Thank you, Annabel. And you just walked a short walk across from there. I'm assuming you walked. Zandile Makhoba, Consumer Economist at Liberty, joins us on the line, as well as Rashaad, Tayob, Portfolio Manager, Foord Asset Management. Let me begin with you, Annabel. Your reaction to, one, the announcement of that focus on the low end of the inflation target range, because I think, yes, the cut was done, but it was expected. That's one side. And then secondly, your thoughts as to what that means.
Yes, I think that's really the big news of the day for our monetary policy. And of course, bringing the focus down from the Reserve Bank side, because the target hasn't changed. National Treasury sets the target range. They even would set the target point. They would decide what's going to happen. But the Reserve Bank deciding, instead of previously, as they looked at the 4.5% midpoint, they're now going to look to try and get inflation to 3%. Remember when we started off with inflation targeting in the early 2000s? Yeah. We tried to get inflation to 6%. Then we worked our way down through the target range. So in a way, the Reserve Bank might be preempting this official announcement, but we have heard in any case from many communications, and the Reserve Bank is very good at these communications. Let's be clear here that they've really been communicating to markets over the course of a number of years that they want to bring the point down. Of course, now today saying formally in a way that they're looking at 3%. That really is going to continue to have some very positive financial market reaction. Right. The rand's a bit stronger, but that's mainly due to US dollar weakness. We would wait and see markets digest this before we'd make a final call. And of course, that would certainly be over the course of tomorrow as well. The good news is that inflation already at 3%, and they're looking now for inflation to be at 3% over the medium term as well. The one point I did want to make is they've actually clarified something in the document. People were wondering, why are real interest rates so high? Right. And it actually says in the document, real interest rates are temporarily higher for a 3% objective. So they actually have been keeping real interest rates high beforehand, yes, to try and get this 3%. And of course, that really explains why the governor was talking about real interest rates earlier, why we probably haven't had bigger cuts, likely also to keep them temporarily higher until this 3% becomes embedded. Part of the cost, but as you said, a modest cost. Inflation is expected to move up towards 4% by the end of this year on base effects, but then come down again next year. Godfrey, if you look at their forecasts, previously they had 4% in the medium term for inflation. That's next year and the following year. Now they've got 3%. So this is something which is starting to become cemented in stone, even if it hasn't officially been announced by National Treasury yet. The Reserve Bank moving quite quickly on this, and I think it's going to, over the course of the rest of this week and certainly next week, have a positive market impact.
There's a word that keeps on popping in my head, unilateralism. Justified or not, it comes across as such.
And I think, it's good news for South Africa, yes, in a good way. And, let's bear in mind that the Reserve Bank and National Treasury actually do work hand in hand. This is not the Reserve Bank going off on its own. Yeah. They're busy examining the need for a lower inflation target and range, and they've communicated many times before. They've virtually completed all the work, and I think this is almost just a forerunner of when National Treasury just makes it more formal. Yeah. But I don't think we should read anything negative into it. Instead, I think we should really see that it's going to allow for more interest rate cuts in South Africa over the longer term.
I needed to raise that. Zandile, your thoughts?
Yeah, I think I agree with Annabel here. We are looking at creating a sense of stability in terms of our financial market, aligning it with global standards in terms of where inflation sits in other regions, and being part of a global economy. I think that's quite important. Just in terms of creating our own stability and our own price leveling. We know that, the exchange rate itself plays a significant role within the South African landscape in terms of what inflation looks like. So a lower target does create an environment for a little bit of a stronger rand, which should benefit consumers across the board.
Absolutely. So in your view, correct decision?
Please repeat the question for me.
Just making the point, is in your view, would this be the correct decision? The SARB is on the correct path?
I would say that it is a correct decision, given the overall positive impacts it should promise. It will not be easily received because as inflation rises, we know that we've used the interest rate to moderate that. And many stakeholders will argue that the interest rate as a mechanism to keep the inflation rate low might in some instances really hit higher levels in the future. So I'm assuming that there are still conversations being had just in terms of getting all stakeholders involved. But it is an ideal timing to kind of move in with this lower target point while we are seeing that inflation is at a lower rate. We also are having a tough economic time in terms of the GDP outlook. So being able to cut the interest rate now while inflation is still at a low level will probably have a positive psychological impact on consumers to try and create a disjoint between lower inflation and a higher interest rate association.
Focusing minds, no question. Rashaad, I imagine amongst my guests today, you probably are the happiest.
Well, I mean, I don't know if it's happy or sad or whether you can call the decision right or wrong, but what I do think is that it's a very optimistic take from the SARB. They place a very high emphasis on inflation expectations being the driver of inflation. I'm not sure whether it's the inflation environment which creates expectations, and the SARB seems to think it's the other way around. So in my view, a good environment would be when an efficient economy is driving inflation lower. It wouldn't be one where you're keeping real rates high in order to really push inflation lower at the expense of the economy. I think there are a lot of headwinds to getting this target and maintaining it. And I think Governor Kganyago spelled them out. He talked about fiscal sustainability. He talked about structural reform. He talked about unit labor costs, and he mentioned them in passing. But these are not easy things to get under control. So yes, we can all be happy that because inflation is close to the new target at the moment, but once it starts ticking up, and if it gets towards 4% or a little bit above by the end or early next year, it places them in a very tough decision and makes the SARB's decision a lot more politicized. So while they may get away with it for now, I think politically you could see a lot more noise coming through into the new year.
Talk a little bit about the cost. Annabel was raising the point earlier that perhaps one of the reasons why you're going to find there's this time that's being taken to get the consensus around a lower target range is because perhaps they are calculating different costs, as it were, or the numbers that they are getting are different. I wanted to find out from your perspective if you agree with the governor's forecast for the potential economic costs here. I think he spoke about a 0.9 percentage point.
Yeah, I think he is tending to underplay the costs because we have quite a challenge in the fact that they're trying to push through this target, and the environment, our debt position, may not be conducive to that. If you look at our weighted maturity on our debt, it's around 10 years, which is very high for an emerging market, and in fact high for a developed market as well. So those high interest costs that we've had over the last few years are locked in. Yes, there will be some incremental benefit, but it's going to take a lot of time before that lower inflation feeds through into the cost of the government debt. We've also got a high debt to GDP ratio teetering close to that 80% level. And if you look at the formula, it's debt over nominal GDP. Nominal GDP is the real GDP plus inflation. If you keep inflation low and you've got low growth, you risk creating a debt spiral. So we need to sort out that growth problem. It's probably more important than the inflation problem. And then lastly, if you look at what's been keeping our bond yields elevated in South Africa, it hasn't been inflation, because inflation has been close to the midpoint for a number of years. They mentioned 2016, 2017. Yeah. What's been what's been the issue is the structural issues in SA, the politics, the debt level. That's the risk premium on our bonds is relatively high, and that's not under the SARB's control. That is a function of the growth environment, the structural, the political. We need to fix those. I think those are more important. The SARB is placing a lot of emphasis in inflation, but that hasn't been the limiting factor on our economy or growth. It's rather been the other issues.
Absolutely. Zandile, I saw you nodding your head.
No, absolutely. I think even the governor himself really highlights how much uncertainty we're in. And it does speak to that sense of a lack of control of many of the moving parts that are contributing to the challenges we have right now. One of them clearly visible in terms of our GDP numbers now, with the tariff announcements really kind of knocking that GDP outlook for this year and the coming years to come. We are a consumer-led economy, and what we've seen just in the first half of this year is that even a slightly lower interest rate has not really been a big booster in terms of consumer credit use and consumption behavior. So we might find ourselves in a very tricky conundrum going forward if we do find that interest rates are either not stimulatory enough for consumers to use credit, or become higher so that it reduces appetite for spending. And then we see household demand continue on this downward spiral, which then doesn't contribute to growth. But yeah, the uncertainty is also an opportunity to experiment a little bit. And a lot of thought is clearly going into this decision now, and kind of positioning us for a future that might look very different from what we've been used to over the past couple of years.
Yeah, sure. Annabel, your thoughts on the costs as well as I think the point that Rashaad is making around the timing of this and potentially what it might mean for monetary policy going forward.
Look, I think it might be a hard ask to get inflation to actually average next year at 3.3%, because their last forecast was 4.2%, and that does change our interest rate outlook now. We had expected one more cut, whether it was in July or November. Obviously it's happened in July, so nothing in November. We're probably not going to get any interest rate cuts next year. And possibly
at a time when the economy needs the relief.
And possibly the following year. And if you look at this, the Reserve Bank has revised down its GDP growth forecast next year to 1.3% from 1.5%. It's revised down its GDP growth to 0.9% from 1%. So there is this cost coming through, as you mentioned. It's not something which, we can pretend not going to happen, even though we're discussing this. There is still this risk, there's still this potential where we could actually see the Reserve Bank maybe missing this forecast that it's got of 3%. It just see 3.3%. It's just very, very low. And that they're almost asking for a full 1% drop without much changing unless there's a plan to hike interest rates. It's a bit of a worry. We know that demand is very weak. So if we don't move into a higher fuel price cycle, if we don't see the fuel price rise, if we see cuts, then it'll be easier to achieve. One of the key points why we have a low inflation in the first half of this year at this 3% that they mentioned is because the petrol price has been cut, not hiked overall for the first half of this year. Now, of course, as well, we've had lots of rand strength, and we also know as well, and they're banking on more rand strength. That's not something you can bank on. The rand's very volatile.
And at the same time, crude prices have been lower as well.
Food prices have been low. Again, not something you can bank on. You can't bank on the weather in your favor, international oil prices in your favor, or the rand in your favor. So without those three effects, who are very big determinants of inflation, if they tend to go in the other direction, then you're going to have a miss. We were talking about structural inflation, we're talking about structural GDP growth drivers as opposed to seasonal, and of course the Reserve Bank mentions that some of the biggest constraints. So what's happening in the transport logistics, the freight crisis, and obviously what's happening internationally as well. Let's not forget, of course, that if South Africa does see this 30% tariff, we've already seen vehicle exports drop off substantially. There'll be some economic growth knock-on effect as well, which could be 0.2%. So I think your point saying that, at a time where we need lower interest rates, this might be, something that comes into the debate, which is a bit of a hard ask. But we can't say that we're going to remain in the same inflation environment that we are now, given what the drivers have been.
So
The rand, sorry.
Am I hearing you say, therefore, that the cost might be much larger, actually, than the governor has made out? I think that was the point that Rashaad was making as well.
If you're going to be rigid, if you're going to really try and achieve this 3%
Yes.
next year and the following year,
Yes.
and you find yourself, as I said, in an environment where the rand is not in your favor, where the fuel price, where oil prices maybe move higher, and of course as well where food prices also move higher as well. Those are big drivers of inflation. And in South Africa, we just also are very exposed to what happens globally as well. Inflation expected to be higher because of the tariffs. So that is very much depends on whether they maybe make use of an escape clause,
Yeah.
or whether they have some flexibility.
Yeah.
We can't tell now.
Yeah.
This is almost in a way a wish list, because it hasn't happened yet,
Yeah.
and they're hoping that the environment remains moderate. You can't bank on inflation expectations,
Yeah.
and we've seen that in salary and wage negotiations in the civil service and across the economy. What we have seen is falling real incomes in the second quarter of this year,
True.
and that's on worries of weak economic growth, but also expectations that inflation is very low now. So again, it depends, how does the civil service wage negotiations come out? Many different factors to consider, which starts to paint a picture that it's not necessarily going to be that easy to achieve these new point. In
Am
the
I
inflation
hearing
outlook.
you say perhaps our risk-averse MPC, and I'm using the word risk-averse in the sense this has been an MPC that we know has been very, very deliberate in terms of driving home its message and been very unwilling to take risks when it comes to fighting inflation, has taken a step too far?
I would say it's perhaps maybe being quite optimistic.
Okay.
But on the other hand, if things do go in its way,
Yeah.
fantastic.
Great.
We reap the benefits, low interest rates,
Sure.
low inflation. I think where perhaps they're really focusing on here is that we're going to have a big knock-on effect to the rand. The rand's suddenly going to become very much stronger,
Yeah.
because we're now looking at 3% in of 3.5. That's
Yeah.
going to be a big driver for inflation.
Sure.
Let's hope they're correct. We'd like that to happen.
Yeah.
But unfortunately, there is this uncertainty going out. I think they're still mindful of risks, financial stability, all the factors they focus on. We would just say it's become a little bit more risky to
Right.
get to the 3% than
Yeah.
it would be if we had the 4.5.
Absolutely. Rashaad, I want to come to you because we need to discuss the merits of today's decision as well and what potentially it means. Annabel has just introduced another element here around the possibility that this cut plus this announcement of the target of the low end of the inflation target range potentially means this might be the last one.
I think that was quite clear. I think the governor almost said that we're going to be on hold at 7% for a while. So in a way, he was promising the benefits in the future if we get inflation down to the 3% level. And if you're talking about a real rate of 2 to 3%, that's when we're going to see our repo rate down at around the 5 level. But in order to get there, we need to be above neutral for some time. And I think that's what he was preparing us for, to say there's going to be a period where we're going to be on hold, and we are going to have rates a little bit higher than maybe what people want, but you'll see the benefits in 2, and I think they talked about 3 years down the line that we will be in a low rate environment. So yeah, maybe we're getting into they believe that they're getting into a period where they can be on hold for an extended period. And I think that's probably correct. What I'll go back to is what happens if inflation ends up at 4.2, 4.3 next year. Under the old target, they could probably sit pat. It wouldn't be an issue. But how are they going to justify this new 3% target and keeping rates at 7? Will they then be under pressure to explain why they're not maybe hiking rates at that point? So I do think that they've been a little bit optimistic about the inflation dynamics within the country. What's the reason for low inflation? It's not the efficient economy, it's the low growth that we've had. And I don't think it's necessarily the 3% inflation that we have is not necessarily a healthy 3% inflation. It's a problematic one.
Sure. Can we draw any comfort from the fact that the QPM has not been a very accurate instrument of projecting future interest rates movement? Rashaad, I'm starting with you again.
Yukia, it has been a difficult environment for the QPM. I think it has been directly accurate, so it indicated correctly whether rates were relatively a little bit higher or a bit lower. But I think the quantum, given the volatile period we've been through, given the COVID period we've been through, I think it's a bit difficult to expect a model to be able to perform perfectly in these type of environments.
For sure. Zandile, very quickly.
Yeah, lots of changes and uncertainty definitely playing a big part. But yeah, I think it's to, the point already made by panelists here is that I don't think it's something that's stuck in stone. I think it's an opportunity that the MPC has seen to kind of start experimenting with an idea that has been there. And my hope is that there will be a lot of flexibility moving forward in terms of just trying to get that right balance between growth, price stability, and monetary stability. So we'll see how it is navigated over the short term.
Do you have any thoughts on, I was going to call it the lack of political buy-in, but let me change that slightly and say the difference in terms of opinion between the SARB and the National Treasury?
Is it very different? I'm not sure. I think
they certainly are not agreeing. The governor wants it today. The National Treasury clearly has said, no, let's take our time, or we don't think we are there yet.
I think the Treasury's focus will definitely be more on the growth outlook. Interest will be much more in terms of creating growth opportunity, looking at more the GDP outlook, more than just the price stability. But I think there seemingly is alignment in terms of that 3% mark. The timing might be more of the question around it. So I think this period does give both an opportunity to see what might happen should we stay here. And I think there's always room for negotiation around that. Primarily looking at ways to create expansionary mechanisms within this low growth environment that we're in is still in the best interest of all of us. And both stakeholders will need to find a way to account for that.
Yeah. Annabel, you agree with this idea that we might be marooned at the current levels of interest rates for a while after today's move?
Well, unfortunately, if you look at the figures here that are contained in the forecast of the South African Reserve Bank, it says no. Yeah. It says that while, as I said, we're probably not going to see another move this year, and we obviously just got, a couple of meetings. Next year, there's a full 1%.
To be cut?
That's forecast, yes. We go from 7 to 6 next year. And that's the repurchase rate, end of period, fourth quarter.
Sure.
So they're saying by the end of next year, there is a 1% cut. That's what the Reserve Bank's communicating, not staying on pat. And in fact, the following year, then you actually stay on pat. So this really means that they are quite optimistic about next year. Now, let's come back to the point we were making about the QPM model. We were saying, has it been accurate?
Traditionally.
This is, yes. This is and not precise, but fairly in the right direction.
Directionally, right?
Direction.
But
so the point here, I think everyone agrees with that, but I think the point here is that the QPM model is now saying a full 1% cut for next year.
Yeah.
So I think the point here is the QPM model might be reacting retroactively. It might be saying, if we get the 3%, then we can have the 1% cut.
Yeah.
I think that might be too soon. So my personal point of view is that no, with the Reserve Bank saying they could have a 1% cut next year, I'm thinking it's more likely to stay on hold, as I said earlier. And the following year, that's 2027, we might have that cut. And that's, of course, in this page where they show the Reserve Bank forecast tables and selected forecast results. Right. Above that, obviously, the 3%. So I would say perhaps there's this QPM model in this case is being retroactive, but looking forward into 2027, more likely when we see cuts.
We certainly hope so. Certainly hope so. Annabel, thank you for your time. Let me also thank my other guests on our program today, Zandile Makhoba, consumer economist at Liberty. Thank you, Rashaad, Tayob, portfolio manager, Foord Asset Management, for your thoughts, for your insights. Thank you very much indeed. And I hope now we're all going to go and read that statement again and again and again until we understand the intent of the governor and the numbers that are accompanying the arguments that they have put forth. The big news, of course, is that yes, we've got another cut, 25 basis points. But the bigger news is that, hello, can I say it? We are moving into a lower inflation target range. And that's a good thing. Thank you for watching. 2 minutes to 4 is your time. On the other side, we're going to go to closing bell, East Africa.